Hello everyone. My name is Trisha, a member of the Investor Relations team at Azalea. A very warm welcome to the Astra 7 Management Presentation video. For Astra 7, we are offering Class A1 bonds and Class B bonds to retail investors. Azalea is committed to investor education. This management presentation recording is to help investors understand the Astra 7 PE bonds before investing. Please take a moment to review the risk statement associated with investing in Astra 7 PE bonds. The prospectus in respect of the offering by Astra 7 Private Limited of the Class A1 bonds and Class B bonds in Singapore can be downloaded from the Astra 7 website, or you can collect it from selected DBS POSB branches during operating hours until close of offer. Anyone wishing to acquire the Class A1 bonds and/or Class B bonds will need to make an application in the manner set out in the prospectus. This advertisement or publication has not been reviewed by the Monetary Authority of Singapore. Our legal disclaimer for this presentation is shown on this slide. Before I introduce our speakers and agenda, please allow me to share what we are offering retail investors in our Astra 7 Class A1 bonds and Class B bonds. For the public offer of Class A1 bonds for retail investors, the bonds have a fixed interest per annum, payable semi-annually. The Class A1 bonds have a legal maturity of 10 years, with a mandatory call at the end of year 5 if conditions are met, such as there being sufficient reserves to redeem the bonds. Their scheduled call date is in 2027, the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on their scheduled call date, there will be a one-time 1% step-up in the interest rate. I'm pleased to announce that for the first time, retail investors will be able to subscribe to Class B bonds. For the public offer of Class B bonds for retail investors, the bonds have a fixed interest rate per annum, payable semi-annually. The Class B bonds have a legal maturity of 10 years, with a mandatory call at the end of year 6 if conditions are met, such as there being sufficient reserves to redeem the bonds. Their scheduled call date is in 2028, the 6th anniversary of the bond's issuance. If the Class B bonds are not redeemed on their scheduled call date, there will also be a one-time 1% step-up in the interest rate. We would like to highlight that you may apply for both Class A1 and Class B bonds during the offer period. This means that you can make one application for Class A1 bonds and another separate application for Class B bonds in the manner set out in the prospectus. We will elaborate more on this in the later part of the presentation. For now, let me introduce the speakers for this presentation. The first speaker is Chief Executive Officer of Azalea, Ms. Margaret Lui. She has been in Azalea since its inception in 2015 and has led the team through the Astrea and Altram transactions. Previously, she was with Temasek since 1985 in various investment roles, with her last appointment being Senior Managing Director. Prior to joining Azalea, she was Chief Operating Officer for 2 of Temasek's affiliate companies. Our second speaker is Mr. Chu En Yao. He is the Chief Investment Officer at Azalea. He has been deeply involved in the Astra Platform since 2014, including Astra 4, the first listed retail PE bond on SGX in 2018. He was previously a senior member of the private equity fund investments team with Temasek, covering fund relationships in Asia as well as global secondaries. In this video, Margaret will be sharing more about Azalea, as well as a short segment to explain what private equity, or PE, is all about. Yao will be giving an overview of Astra 7 and the key risks involved. I will then wrap up with the key takeaways from this management presentation. We will be holding a live management presentation event. Margaret and Yao will be there in person to answer questions you may have about the Astra 7 public offer of Class A1 bonds and Class B bonds. You may sign up for the event by scanning the QR code or via the link shown on the screen. Thank you, and I hope you enjoy the rest of this presentation.
Hello everyone, I am Margaret Louis, CEO of Azalea Investment Management. Thank you for being with us here today to let us share more about the Astra 7 PE bonds with you. Besides Class A1 bonds, I'm very pleased and excited to be able to offer Class B bonds to the retail public in Singapore for the first time. This is in line with Azalea's mandate to continually innovate and broaden investors' access to private equity. Before that, please allow me to introduce and share more about Azalea. Azalea was set up in 2015, and we are the parent of the issuer and manager of Astra 7. Azalea is an indirect wholly owned subsidiary of Temasek and a direct subsidiary of the Serviora Group. However, our board and management team remain independent. Azalea's mandate is to develop products and investment platforms to make private equity accessible to a broader investor group. So, Azalea is not only an investor, but a developer and manager of private assets with private equity, or PE. Azalea's management team has extensive experience in PE. Over the years, we have taken a phased approach to bring PE exposure to retail investors through innovative ways. We developed and successfully launched Astra 3, the first PE bond in Singapore, in 2016. Subsequent series of Astra PE bonds, Astra 4, 5, and 6, were available to the retail public in Singapore across the years. We are long-term investors in private equity, and we invest alongside external investors in our products. As a developer, we continually create innovative products that provide investors access to private equity, meeting the needs of investors with different risk appetites. Lastly, as a manager, besides investing in and managing portfolios, we are committed to investor education. That is why we're here today, to share about private equity, the Astra Platform, and Astra 7 with you. So, what is the Astra Platform? It is a series of investment products based on portfolios of private equity funds, also known as PE funds. Each of these Astra transactions involve investment products based on portfolios of PE funds. Temasek launched Astra 1 and 2 in 2006 and 2014 respectively. The Astra 1 and 2 transactions were offered to institutional investors. In 2016, Azalea launched the Astra 3 transaction. This introduced the first listed notes in Singapore that were backed by cash flows from PE funds. The notes were offered to institutional and accredited investors. In 2018, Azalea launched the Astrea 4 transaction. It was the first listed retail PE bond in Singapore and was a milestone in achieving Azalea's vision of connecting individual investors to private equity. Through Astra 4, retail investors in Singapore were able to invest in PE bonds for the first time, alongside institutional and accredited investors. Following Astra 4, Astra 5 was also successfully launched in 2019 and Astra 6 in March 2021. Astra 5 and 6 reinforce Azalea's commitment to bring PE bonds to retail investors regularly and deepen Singapore's capital markets. Next, allow me to introduce the members of the Astra 7 board to you. Joining myself and Eun Yao on the board is Mr. Khan Sheikh Lam, who is also a director of Astra 4 and 5. Sheikh Lam has rich experience in capital markets and will be able to complement the PE investment and structuring experiences for Eun Yao and myself. With that, this ends my introduction to Azalea and Astra. Before we go into the Astra 7 transaction, I would like to spend some time to talk about private equity, the underlying asset class of the transaction. This private equity primer will provide some insights on the asset class that the credit of the Astra 7 PE bonds is based on. Private equity in general refers to investments in private companies. Majority of the private equity investments are made by private equity funds. The PE funds are managed by private equity managers, also known as general partners or GPs. Investors are commonly referred to as limited partners or LPs. The GPs of the fund strive to make operational improvements and create value to these companies before selling them for a profit. Private equity investments is common around us. As general examples, you can see many familiar brands or companies invested by private equity funds. As shown in this chart, you can see that the private equity market has grown significantly in the last 2 decades, growing at an annualized rate of 12.8% to reach $7.6 trillion in June 2021. There are various strategies in private equity like buyout, growth equity, private debt, and venture capital. Of the various strategies, buyout and growth equity have produced consistent median returns of 15 and 13.8% per annum respectively. Buyout funds focus on purchases of controlling stakes in companies to make operational improvements, while funds that employ growth strategy invest in fast-growing companies. The Astra 7 portfolio is strategically weighted to buyout and growth equity. In terms of returns, private equity as an asset class has also outperformed the public markets over the longer term. Here, you can see the typical cash flow profile for an investor in a private equity fund across its fund life that spans across more than 10 years. In the initial years of the fund, there will be cash outflows as the GP draws capital to fund their investments. These cash outflows are represented by the pink bars. Over time, once these investments grow and become profitable, the GPs sell them and generate returns for the fund, distributing cash back to investors. These cash inflows are represented by the purple bars. You can see that the cash generative phase in the life cycle of a PE fund is in the later years, represented in the shaded area. The net effect of the cash outflows and inflows is represented by the gold line. This is also known as a J-curve because of its shape. To ensure more certainty over cash flows, Astra portfolios only consist of secondary PE funds, meaning that the funds are in the later or mature phase of their fund lives when they are more cash generative. The portfolios are diversified with many underlying investee companies and are managed by quality fund managers. A portfolio of PE funds can have superior downside protection versus investing in a single PE fund. Here, we compare the risk of capital loss of a single PE fund, a primary fund of funds, and a secondary fund of funds, using historical data from Preqin, a database provider covering more than 4,700 funds from 1990 to 2017. A primary fund of funds is one that invests at the inception of the funds, whereas a secondary fund of funds refers to portfolio of interests in mature funds like the portfolios in the Astra transactions. As shown on this slide, investing in a portfolio of secondary fund of funds has competitive risk-adjusted returns, with only 2% of secondary fund of funds experiencing a capital loss. That is why Astra's 7 portfolio is more seasoned and cash generative. Diversification of the portfolio also lowers risk of capital loss, giving the Astra 7 portfolio superior downside protection. PE is traditionally a very inaccessible asset class due to the high barriers to entry. The minimum investment sums for PE are high. The holding period is long, and individuals have limited access to good funds. However, our Astra 7 bonds can mitigate these barriers to entry and connect investors to private equity through the following. 1. Astra 7 bonds allow for bite-sized investments, which means investors do not have to put in large amounts of capital to invest. For the Class A1 bonds, the minimum subscription is 2,000 Sing dollars, and the bonds are traded in denomination of 1,000 Sing dollars on SGX. For the Class B bonds, the minimum subscription is 2,000 US dollars, and the bonds are traded in denominations of 1,000 US dollars on SGX. 2. Investors' capital is tied up for a shorter amount of time. The Astra 7 Class A1 bonds are scheduled to be redeemed on year 5 if conditions are met. The Class B bonds are scheduled to be redeemed on year 6 if conditions are met. 3. The Astra 7 bonds are backed by cash flows from a mature and diversified underlying portfolio that mitigates the risks of the J-curve effect. I hope that this segment provided a clearer picture of what the asset class of private equity is all about and how Astra 7 PE bonds mitigate barriers to investing in PE funds. Thank you.
Hello, my name is Enyao. I'm the Chief Investment Officer at Azalea. Thank you for taking the time to join us to understand the Astra 7 transaction. Astra 7 is offering 3 classes of PE bonds, Class A1, Class A2, and Class B. This table here shows an overview of all 3 classes with their respective issuance sizes, expected credit ratings from Fitch and/or S&P, interest rates, scheduled call dates, and maturity dates. all the interest rates for the different classes of bonds have been set and priced by institutional and accredited investors through a competitive book building process. A portion of Class A1 bonds and Class B bonds are offered to retail investors in Singapore through the public offering. The remaining bonds were distributed to accredited and institutional investors through a placement offering. The bonds are backed by cash flows from a diversified quality portfolio of private equity funds. Class A1 bonds are expected to be rated A+ by both Fitch and S&P, while the Class B bonds are expected to be rated BBB+ by Fitch. These are both investment-grade ratings. Both Class A1 bonds and Class B bonds will be listed and traded on the SGX main board. For the public offer of Class A1 bonds for retail investors, the bonds have a fixed interest rate per annum payable semi-annually. The Class A1 bonds have a legal maturity of 10 years with a mandatory call at the end of year 5 if conditions are met. Their scheduled call date is in 2027, the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on their scheduled call date, there will be a one-time 1% step-up in the interest rate. I'm pleased to announce that for the first time, retail investors will be able to subscribe for Class B bonds. For the public offer of Class B bonds for retail investors, the bonds have a fixed interest rate per annum payable semi-annually. The Class B bonds have a legal maturity of 10 years with a mandatory call at the end of year 6 if conditions are met. Their scheduled call date is in 2028, the 6th anniversary of the bond's issuance. If the Class B bonds are not redeemed on their scheduled call date, there will also be a one-time 1% step-up in the interest rate. Here, you can see the capital structure of Astrea 7. Class A1 and A2 are pari passu, which means that they rank equally in the capital structure. They also rank senior to the Class B bonds. Class B bonds rank junior to and will be paid after the Class A bonds. Hence, Class B bonds have a higher risk profile as compared to the Class A1 bonds. As mentioned earlier, in addition to the Class A1 bonds which have been available for retail investors since Astrea 4, Class B bonds are now also offered to retail investors for the first time. Each tranche is rated independently by international rating agencies Fitch and/or S&P, and the ratings reflect the credit quality of each tranche of the bonds. It is important for you to note that Class A1 bonds are issued in Singapore dollars, while Class B bonds are issued in US dollars. This means that Class B bond holders whose investment currency is not in US dollars may be subject to exchange rate fluctuations between their investment currency and the US dollar. Astrea 7 bonds are issued at a conservative LTV ratio of below 40%. This means the portfolio value is more than twice the amount of the bonds issued. If there is an event that significantly impacts portfolio value and the ability of the portfolio to generate cash to support the bonds, Class B bonds, being the most junior tranche of the bonds, will be affected first. With the LTV ratio below 40%, this means that the Astrea portfolio will need to lose more than 60% of its value before Class B bond holders are impacted. As the Class A bonds rank senior to Class B bonds, the portfolio will need to lose a greater amount of value at 70% before Class A bondholders are impacted. Here, I would like to share a little about the transaction structure. The transaction is managed by Azalea and the cash flows are administered by Sun. Sun is an established fund administrator and its parent is listed on the London Stock Exchange. On the right are the other counterparties involved in the transaction. We have DBS Bank acting as credit facility provider. This credit facility can be drawn to pay capital calls issued by the underlying PE funds or to pay interest on the bonds in case of cash flow shortfalls. Other counterparties include the hedge providers, as well as the bond trustee and the security trustee. Here, allow me to explain in simple conceptual terms on how Astra 7 PE bonds are backed by cash flows from investments in 38 PE funds. An Astra 7 subsidiary owns interest in the 38 PE funds. Altogether, these funds have invested in a total of 982 investee companies at launch. When investments in these companies are sold by the PE fund managers, the cash is distributed to Astrea 7. The cash can be used to fund capital calls at any time, and at the end of every 6 months, any remaining cash must flow through a waterfall called priority of payments. How the cash can be used is strictly governed by this waterfall. I will now share a simple conceptual illustration of how the priority of payments work. Astra 7 pays out every 6 months. Clauses 1 to 4 represents key fees and expenses necessary to run the structure. In Clause 1, available cash flow is used to pay for any taxes and administrative expenses up to a cap of $0.9 million per distribution period. In Clause 2, payments under the hedging arrangements. In Clause 3, payments are made for the management fees. In Clause 4, payments are made to pay commitment fees for the credit facilities, as well as any interest and principal if the facility is drawn. Clauses 5 and 6 represents interest payments to all bondholders, with Class A bondholders ranking ahead of Class B bondholders. Clauses 7 to 10 represents cash used for reserves and principal repayments. If the issuer sells any of the PE fund investments, Clause 7 ensures that the net cash proceeds from any sale after fulfilling senior obligations can only be used to fund the reserves account or to repay any outstanding bonds. There are separate reserves accounts for Class A bonds and Class B bonds respectively. Clause 8 allows sufficient cash to be built up in the Class A reserves accounts to redeem Class A bonds. Regular reserves amount equivalent to 10% of the principal amount of the Class A bonds are scheduled to be set aside every 6 months for the eventual repayment of the Class A bonds at the end of year 5. If at any period the scheduled amounts are not fully reserved, the issuer has to make good on any outstanding amount in the subsequent period before continuing with the regular reserve schedule. Once Class A bonds have been fully redeemed or reserved, Class B bonds will begin reserving, with 90% of the available cash then flowing into the Class B reserves accounts. Clause 10 is a structural safeguard. This is where the maximum loan-to-value or LTV ratio is measured to ensure there are sufficient assets remaining in the structure as buffer for bondholders. If the 50% LTV ratio is exceeded, the sponsor cannot receive any cash unless more cash is set aside in the reserve accounts or bonds are repaid such that the LTV ratios falls below 50%. Clauses 11 and 12 takes care of any remaining expenses and cost. And finally, we have clause 13 as payment to the equity investor. Here, I would like to share what are the key differences between Class A1 bonds and Class B bonds other than their differences in ranking. Class A1 is issued in Sing dollars, while Class B is issued in US dollars. Class A1 has a slightly earlier call date as compared to Class B. Both A1 and Class B are rated independently by credit rating agencies. Class A1 is expected to be rated A+ by both Fitch and S&P, while Class B is expected to be rated BBB+ by Fitch. Class A1 bonds and Class B bonds have a different coupon rate per annum as shown on this slide, both of which are payable semi-annually. Our bonds have three key credit strengths that I would like to highlight. 1. The bonds are backed by cash flows from a diversified quality portfolio of PE funds. 2. With an over-collateralized capital structure where the portfolio value is more than twice the amount of the bonds issued, the LTV ratio is below 40%. 3. There are several structural safeguards to ensure bond interest and principal repayment to be paid on time. Let's go through these in more details. The Astrea 7 portfolio is geographically diverse, with a majority in the US and the balance in Europe and Asia. US is the most developed PE market, while Europe and Asia are fast-growing and provide diversification. The Astrea 7 portfolio is strategically focused, with over 75% of the portfolio comprising of buyout funds and the remainder in growth funds. There is no single name concentration in any funds or managers. The portfolio is diversified across vintages. The portfolio is mature and it is cash generative. The portfolio comprises of 982 investee companies across many different industry sectors. The largest investment is less than 1.5% of the portfolio NAV, showing how well diversified the portfolio is, with no single company concentration. The capital structure is over-collateralized, and the total amount of bonds issued represents less than 40% of the portfolio value. This means the value of assets is more than twice the value of the bonds issued. Another credit strength is the provision of structural safeguards. First, there are reserves accounts. Cash is reserved into the Class A reserves accounts every 6 months to build up sufficient cash to redeem Class A bonds. Once Class A bonds have been fully redeemed or reserved, Class B bonds will begin reserving, with 90% of the available cash then flowing into the Class B reserves accounts. Second, there is a maximum LTV ratio mechanism. If the LTV exceeds 50%, cash cannot flow to the sponsor and must be used to deliver the structure by either accelerating payments to the reserves accounts or by repaying the outstanding bonds. Third, there is a credit facility provided by DBS Bank. In the event of cash flow shortfalls, the credit facility can be drawn to fund certain expenses, including management fees, interest expenses, and capital costs. However, the credit facility cannot be used to repay the bond principal. This concludes the overview of Astra 7. Thank you. It is important to remember that all investments carry risk. In this segment, we will talk about the 3 key risks of investing in Astra 7 PE bonds, which include investment risk, market risk, and leverage risk. First, let's talk about investment risk. The nature of private equity fund investments is that the amount and timing of cash flows are uncertain. In addition, there are limited disclosures with regards to the underlying investee companies and their performance, some of which could potentially relate to a decline in returns or cash flows of the fund investments. Next is market risk. An adverse change in macroeconomic or market conditions resulting from events such as changes in the geopolitical landscape, like those arising from armed conflict, trade tensions, natural disasters, or global pandemics, could result in falling PE asset valuation and/or reduction in deal activities. This may lead to less distributions from fund investments if the underlying investments were sold during a period of declining asset valuation or deal activities. As you know, the COVID-19 pandemic is ongoing, and there is continued uncertainty around the trajectory of the pandemic and its impact on the global economy, which may have an adverse impact on the valuation of and cash flows from fund investments. Third is leverage risk. PE funds are likely to employ leverage, meaning the use of debt for investments. Use of leverage may also expose investee companies to adverse financial or economic conditions and impair their ability to finance operational and capital needs. There is no assurance that the current interest rate levels will persist. Cumulative effect of the use of leverage and adverse financial or economic situations could result in substantial loss to the portfolio PE fund or to the investee companies, thus adversely impact the cash flows to Astra 7. In addition, it's important to remember that Class B bonds are US dollars denominated bonds. Class B bondholders whose investment currency is not in US dollars may be subject to exchange rate fluctuations between their investment currency and the US dollar. Such fluctuations may result in foreign exchange losses for these Class B bondholders. This concludes the segment on the key risks of investing in Astra 7 PE bonds. Other risks can be found in the prospectus. Thank you.
I hope that you have found the management presentation to be useful in understanding the Astra 7 PE bonds. Before we wrap it up, I would like to do a recap on the key takeaways. Class A1 and Class A2 rank equally as the most senior class of the bonds. Class B PE bonds rank junior to and will be paid after Class A bonds. Both Class A1 bonds and Class B bonds are available to the retail investors in Singapore. Class A1 bonds are issued in Sing dollars, while Class B bonds are issued in US dollars. The bonds are backed by cash flows from a quality portfolio of investments in 38 PE funds diversified globally. The portfolio is cash generative, and we have also built in structural safeguards. All our bonds are also expected to be given an investment grade rating. We would like to highlight that you may apply for both Class A1 bonds and Class B bonds during the offer period. This means that you can make one application for Class A1 bonds and another separate application for Class B bonds in the manner set out in the prospectus. While the Class B bonds are US dollar denominated, applications for the Class B bonds will be made in Sing dollars based on a predetermined exchange rate. Should you be unsuccessful in your application, or if you are only partially allocated, all refunds of unsuccessful or partial allocation will be credited back to you in Sing dollars at the same predetermined exchange rate as application. This means that, as a Class B bond applicant, you will not be subjected to any foreign exchange volatility during the application period. As a Class B bondholder, do note that even though interest and principal payments on the US dollar denominated Class B bonds are made by the issuer in US dollars, you will receive Class B payments in Sing dollars by default into your designated bank account converted by CDP at such exchange rate provided by CDP's partner bank. This is unless you choose to opt out from receiving payments in Sing dollars via CDP Internet. If you opt out, your foreign currency cash distribution will not be converted and will remain in your cash balance with CDP. However, please note that telegraphic transfer fee imposed by CDP in addition to applicable receiving bank charges per withdrawal request. For more information, do refer to the Currency Conversion Service section under CDP's FAQ page at the URL as shown on screen. Before you invest, please read more about the Astra 7 PE bonds in the prospectus and product highlights sheet. Printed copies of our prospectus can be found at selected DBS and POSB branches, or you can download a copy from our website. You may also watch our illustrated explainer videos, which are also available on our website. You can apply for the Astra 7 Class A1 bonds and or Class B bonds through the following means as shown on the screen. As a reminder, we will be holding a live management presentation event. Margaret and Anya will be there in person to answer questions you may have about the Astra 7 public offer of Class A1 bonds and Class B bonds. You may sign up for the event by scanning the QR code or via the link shown on screen. With that, I would like to thank you for taking the time to view our management presentation. You may wish to visit the website to download the prospectus. Thank you.